I do not see a big, huge market crash, is because I think that the toothpaste is out of the tube. You know what I mean? Like, meaning I think that the inflationary trade and the currency trade is on.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And after a long time out of the office and out of the act, I am joined again by the brain trust himself, Mr. Chase Taylor. Welcome back, Chase. It's been a while. I'm glad to know that some of us actually have to work, on a day-to-day basis. And I hope you enjoyed your life of leisure.
It's good. It's a good thing we're not keeping score from the summer. Yeah.
Well,
I let everyone else take their vacation in the summer, and I go in the fall.
That's it. That's about par for the course for you. You would vacation in the fall. Like, who vacations in the fall? Chase does.
It is my favorite season, and it's contrarian of me to do so.
No, it's not. It's perfect. It's right. It goes right along with you. And now that you're saying it, I'm shocked that I ever thought that it wouldn't be your favorite season to go on vacation. Of course it is.
Exactly.
Fits right in there. Anyway, little bit happened while you were gone.
Really only Friday, but yeah.
Yeah, right. Just nothing. The interesting thing I thought, though, I think there's a lot of interesting things about it. It was interesting because you and I thought that we were going to have some kind of vol event, or event's probably too big a word. But we're going to have a little bit of a shakeout. It's kind of funny because the reason we had it really had nothing to do with the reasons that we thought we were going to have it. Right. It just took it.
Right.
But I kind of was saying on Friday that I hate using this term because I think we've been very explicit about, do we think the market is a bubble? Yes, parts of it. I also don't think that we're opening up and having some big catastrophic loss. We said that multiple times. But the interesting thing about it is you just felt so overrun, at least in the interim. It felt like a balloon looking for a pin, and it just needed something to let some steam out. And what we were saying on Friday is that I think Trump's tweet was just a reason for the market to do what I think it structurally wanted to do anyway. And then our take on that was, let's see, because a move like this, for a variety of different reasons, could have some follow through. I mean, if you look at the market, you've gone straight up without so much as blinking since April, with volatilities getting ground into dust. And we said, anytime you get a VIX up 25% or more in a day, look for a rally the following trading day. You're not going to follow through. So we took profits on vol. It didn't really change positioning much today, just because it kind of went exactly like we thought. What do you think, though? I mean, we've got CTAs in a position where they are in negative gamma still, correct?
So today's close would have pushed us probably back. It's like a really neutral position where it's like a razor's edge between, neutral, positive, and negative, judging by my guesstimate as of now.
Yeah, if you were to put a gun to my head right now at this moment, for one reason and one reason alone, I am leaning toward the fact that I think this was a little bit of a relief rally. And my guess is that you're going to see more downside action and higher volatility going into the end of the week. Main reason why I believe that is the dollar. The dollar did not confirm any of the action that we saw in the market today. And I think in situations like this, at least in my experience, I usually trust the currency moves over the equity moves and risk asset moves.
Yeah, I think.
What do you think?
Like, given everything, I think the relief rally view is kind of right. That, if you look at just how much we fell Friday versus how much we came back today, it's not that impressive. And in a way, you got a de-escalation, but not like a full one. Neither side was really took it all the way back or offered the full explanation of like where we're going from here. So in that way, the market response was kind of like, it made sense. It makes sense to relief rally, but not all the way back. And to think about that systematic side, like very, very over positioned in systematic strategies. And I would say we burned off 10 to 15% of that on Friday. So like you're still, they're long and strong. And today we talked about this in our meeting, but like, being up 1.5% today, that is higher realized vol than we've had for the last, 2-3 months or whatever. So even that is not good for vol control because they are like, ooh, higher realized vol, we need to sell some more. So I think this makes tomorrow a big deal. I very rarely is a single day in the market a big deal in reality. Tomorrow, because of the systematic structural stuff, like it actually is a pretty big deal. Because if you keep rallying, get back into positive gamma, then you can kind of put a cork in this thing for a little bit longer. But because you haven't burned off enough of that positioning, it's still like you just kind of remake this trap door for the future. So in my opinion, everyone should want this to go a little further along, get that positioning rinsed out and kind of clarified, because until then it's just like hanging over your head. But I'm with you. I think, maybe only 60-40 in the way I'm viewing it, but that the rest of the week you still need to see some more downside.
One interesting thing about today, though, that doesn't, that kind of just sticks out, and it could be a tell, and I think right now it is. Gold didn't just bounce back; gold made a new high.
Yeah, silver new big high.
Yeah, which is really interesting, and ironically goes to one of the biggest reasons why I do not see a big, huge market crash. Is because I think that the toothpaste is out of the tube. You know what I mean? Like, meaning I think that the inflationary trade and the currency trade is on. And I think the dollar is going to do really badly for an extended period of time against assets, inflationary assets like gold, precious metals. Bitcoin looks less interesting here. I'll leave the technical analysis up to you, but considering what's been going on in the market and then considering what's going on with gold, I would have expected Bitcoin to behave a little bit differently in there. I've seen some action in Bitcoin that, again, not calling it one way or the other, but I think it's vulnerable here, at least in the short run. I could be wrong on that, obviously, but you have any thoughts on that? You've been looking at that chart at all?
Yeah, I still think Bitcoin's going to be fine, in this taking advantage of like the debasement trade thing, like the liquidity proxy. We know we're going to keep getting liquidity. So I think it's going to be fine. But it is notable how well gold's done versus Bitcoin, this year, which is something that we hadn't really gotten used to. Like, and I think what we do know is like when you get these risk off environments in the last year or two, like we used to have gold like not appreciate that either. Bitcoin has always hated that. If it's risk off, it goes down. There's a lot of leverage in there, so like it's always going to throw up on itself whenever you have a liquidity event. This year, at least, gold doesn't really care that much about liquidity events. Now that can easily flip or whatever, but for now, like gold has been sort of like bulletproof for anything bad to it. Like dollar up, doesn't care. Like it just, central banks are buying, now everyone else is buying. Like it's just hard for it to go down. And to be fair, like if you back away and think about it, like gold is on some level being remonetized. It's finding its way back into, global markets as not just a thing that some weirdos have in a vault. It's things that central bankers want in size. It's things people use to settle trade in size. Like there's a reason, people don't want treasuries. They don't want dollars the same way they did 5 years ago. They want gold for that. And because it's a small market, it's hard for it to go down for now. Now, the volatility has been really high in gold lately, which is a little scary. Like it makes you feel like if you do get a down move, it could be big, even more so for silver. But I think Bitcoin will be fine, but it is worth hammering home how much better gold has been this year, at least. And I think the leverage aspect in crypto, which I mean, obviously we saw Friday and in the weekend, but the leverage aspect on the crypto side is so brutal that it makes it hard to trust where it's at any given moment. And like, I don't think anyone's 50x levered up on gold the way obviously some folks were that got carried out in the underworld parts of crypto over the weekend.
You wouldn't be talking about the always classy fart coin, would you?
Yeah, among many others. And that
yeah,
one,
Doge got wrecked.
At least everyone knows those are fake. But the sad thing is, a lot of people have deluded themselves into believing some of them were like kind of real, and you know they let themselves.
You mean
get
trading sardines?
15 times levered, and yeah, exactly. And the problem with
Yeah,
problem with that kind of leverage is a 10% drawdown means game over.
Yeah, well, and it takes me back to that old joke that it just is so perfect for. Well, no, of course that's not an eating sardine. That's a trading sardine. You don't eat that one. That's different.
Yeah.
And listening to these guys talk about some of the different crypto stuff, I can't help but to start laughing. Not because I'm mocking them or I think they're stupid or whatever. It's just so funny to see life imitate a joke, or art. And you're kind of sitting there going, I can't believe I'm listening to this right now. I am literally listening to guys saying, no. That's a trading sardine. That's not an eating sardine. Just, you live long enough, you see it all, right? One of the things I was going to talk about with gold, and you said something that I am increasingly coming to the side of this argument and increasingly see it this way is, I think that's exactly what you see happening, and it is a re-rating in gold, right? Like a base money getting re-rated, and I think that base money is getting re-rated for a whole host of factors. And I think simultaneously, it's also kind of the global financial system's acknowledgement that the dollar is not going to be the player that it's been over the past 50 years, right? Like they are for the first time in a way hedging their dollar exposure and their dollar risk. I think when you look at where gold was trading, 10 years ago, and you look at what's happened in the last 10 years, I don't think it's, like we've said so many times, I get a chuckle if I see somebody pointing out gold and referencing it as something that has moved too high, too fast, right? Like it's been an aggressive move, but if gold is your indicator of froth in this market, I would say, how long have you been here? Has it been 2 weeks or 3? A. And B, just, what exactly are you looking at to? Because if you comp it to, price to money supply, price to these, all of those things say that it's not overrun whatsoever, right? And then the other thing, and you got to be careful with this because I've been involved in trades like this for a really long time, and I know a lot of this is nonsense. But it does smack true. I'm reading more and more stories and more credible stories about different companies, different investors, different people with appetites for physical metal just not being able to get it, right? That there's just you just don't have as much physical supply right now. And it's not across the board, but just I am hearing increased stories of it taking longer to get physical metal. There being clogs, there being issues. And that's something really interesting. And the reason why I say it's interesting is it's been a very long time since gold has played its true historical role in the average portfolio. Do you think that's fair to say? Right?
Yeah, very, very much. So.
If that is what's happening right now, and it's certainly happening on the central bank level, but if that is what's happening, if it's getting back, like let's say gold is coming back to where it's going to own 15 to 25% of what used to be the 40% of the portfolio you allocate to bonds. Okay. And you're seeing a lot of articles about this. I tend to agree with them. I think for a whole host of reasons, that makes a lot of sense. My point in saying that though, is that the dynamics around gold and the monetary system, generally speaking, are so different than they were that last time gold played a normal run-of-the-mill role in a portfolio. And if all of a sudden it becomes widely accepted that the average retail portfolio should have somewhere between 5 to 10% exposure to gold, which keep in mind that, again, like I said, that's just an allocation of 15 to 25% of what your old bond portfolio used to be, right? That is something that the physical gold market is not ready for. It's not ready to meet that level of demand. And I think that dynamic suggests, and I hate sounding like a crypto guy or a Bitcoin guy in this environment, but that dynamic alone suggests that this could be very early innings for gold, and it could go substantially higher from here.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
All right. Well, we're back after dealing with some technological difficulties. We lost Chase, but what I was in the process of saying is, it seems very logical to me to watch retail or regular investment portfolios sort of follow through with what you're seeing central banks do, which is gold is now taking a prominent place on central bank balance sheets for obvious reasons to hedge out dollar risk. And I think that you're going to, with that demand, and then when you look at the proliferation of dollar denominated debt and how that continues to, right? You've kind of tapped this unending need for central banks to be in the accumulation phase because their dollar denominated exposure continues to rise, right? And even if it's rising at a slower rate. But the point that I was making is it's only natural to think that you're going to see investment portfolios writ large follow that trend to some degree. And I also think it makes sense. And we've seen a lot of the articles that people have talked about, which is, the new 60-40 being half gold. That seems a little bit excessive for me. I still think that fixed income at 20% of a portfolio in this environment seems to not make a whole lot of sense. But let's say somewhere between 15 to 25% of that traditional 40% slice that went to bonds started getting allocated to gold, which like I said, I think that makes all the sense in the world. And I think you're just at the beginning of starting to see that. What I'm saying is that the last time that gold played a predominant role in the net worth or the portfolio or the financial portfolio of the average American was quite some time ago. It's quite some time ago. If that comes back around, I think you're looking at a completely new modernized economy, financial system, right? All that, and a gold market that really hasn't changed much. And so I see sort of a wave of demand coming toward the physical markets that they're not really in a good position to be able to facilitate. Anyway, it's a long-winded way of saying, boy, I see a lot of levers to push gold and precious metals writ large substantially higher. And I'll be honest with you, I don't really see, other than regular market machinations and shakeouts and things like that, markets doing what they do. I don't really see any downward pressure for things like gold at anywhere in the near distant future.
Yeah, I mean the catalysts are in place, and like silver's worse from like a supply and demand perspective at the moment, which frankly you could see coming last year. Like it has so much demand from the industrial side. It's pretty clear. Like, hey, if we get a surge in investment demand, there's not enough. Like just literally, no. And I made the same point. With the PGMs, like that. Their like margin for error is so thin. In gold, like I said earlier, it's such a small market that it really, this is the only way it can deal with like any sort of this surge like we're seeing in demand is for the clearing price to go up a lot. Now, I do think that.
All right, you know what? We lost Chase. We're gonna have to press on without him.
Sporty, just from.
But anyway,
if you compare,
if you allow me, I think I might finish what he was saying. Which
global
is
money supply or whatever, like
the point that I'm getting
shooting
to is
higher in a way that is a little unnerving, but at the same time,
so many times in life and investing and economics and oh, there you are. You're back. I was filling in the gaps. We lost you again. Yeah.
All right. I was just talking that whole time, but all good.
Well, I was summarizing and what I said was what I think he's getting to is exactly what I'm getting to, which is that this is kind of a little backwater corner of the world that's been effectively ignored for the last 15 years. And, meanwhile, the money supply has gone through the roof and debts have gone through the roof and deficits and all that. And now all of a sudden, if that market that has grown exponentially in terms of liabilities and money supply and M2 and all that kind of stuff, if gold picks back up that traditional place of a portfolio, there's just not enough for it. And I think that's what you were illustrating.
Yeah, exactly. And I was just talking about how it's even more pronounced in silver in a lot of ways. And to talk about it from the portfolio management standpoint, this is something I wrote a big piece back in 2018, basically saying like, hey, like the deficit stuff's going to get way worse. Inflation's going to get way worse. Like the only way through this is to do all this. And the answer is no fixed income or very minimal, and way more gold and just more real assets in general. And on the fixed income thing, this may be controversial, but my view is for the next probably 20 years or so, the only fixed income that will make sense to me is very short-term stuff, and only if real interest rates are positive. If inflation's 3 and rates are 4, like, yeah, just buy the 2-year. That's fine. You're going to do okay. That's a good position. But owning duration or owning the 2-year, if it's negative 1% real interest rates or something, no. All that should be replaced by a lot of gold, maybe, and then a sliver of crypto, and by that I mean Bitcoin essentially, and a sliver of just other real assets, like, owning some copper and some, platinum and like other metals and natural gas. All this stuff's going to be fine too, or, good real estate. Like all these things work. Plus the thing we've talked about all year, like if the dollar is going to do this, then having, ex-US equities becomes a big deal. It feels like our market is super frothy. The S&P is up 13% year to date. I mean, Vietnam's up 70, South Korea 64, Peru 60. I mean, Africa's up over 50%. Like, these aren't like, blue chips. Colombia's up 45%, Mexico 39. Like that's what a dollar problem world looks like. So the average US investor might think they're doing pretty well this year without realizing they're actually losing purchasing power on a global basis versus what they could have owned.
Yeah, no, it's remarkable. Then, again, to sound like a broken record, or risk to sound like a broken record. The other thing that you just again, it's one of those things that I just don't think that you can overemphasize enough, which is if we're even marginally right on any of these things. And even if we're not, even if your forecast for gold, let's say you think the top is in, and you think gold's going to trade sideways in a range between here and let's say $2,500 an ounce. Okay. Gold miners are still ridiculously stupid cheap, even at $2,500 gold, let alone 4,000. People looking around the world, where are the opportunity? I continue to be amazed at how underexposed the average portfolio is. And I don't care what you think about miners. I don't care if you don't like the business. I don't care if you don't like geopolitical risk. I don't care if you don't like gold. Okay. If you like cash flows and value, go buy some. I didn't say it needs to be 20% of your portfolio, but just if you believe in buying things cheap, and if you believe in buying discounted cash flows, go check out some gold miners.
Yep.
I mean,
it's another thing we talked about all year. I mean,
at risk of our precious metal analyst, Pat, hearing this, because I don't want to get him too excited, but he's right. And he's been saying it, and we've all been saying it and echoing it, just that especially if you're one of those guys that's got some pretty well-based reasons to not like gold. Let's say you've done the research, you've invested in it before, they're bad business. Okay, let me just challenge you. Go back and rerun it. Go back and go look and pull up an Agnico Eagle, right? Go pull up a DC Gold. Go pull up a good quality miner and go run the DCFs on them. Go look at the balance sheets. Just go do the work. And then the other thing you'll notice too is that, and like we've been making this argument for a long time, these things look really stupidly cheap on just a cash flow basis. And remember, that's assigning absolutely zero value or market cap or anything for the actual gold mine they're sitting on, right? The underlying asset itself. So, I think that's why, there's so many questions. Why would John Paulson be buying an undeveloped mine? Well, because the undeveloped properties right now, gold in the ground, is bizarrely, stupidly discounted to a level that doesn't make sense. So I actually thought it was an incredible investment move on his part to go in there and buy $1 billion of that undeveloped project, because look, yes, is there risk? Is there a cost and all that kind of stuff to get the gold out of the ground? Yes, but like Buffett says, there's no bad assets, just bad prices, right? Which is you're getting these projects and that land at a price that's almost like it's raw land, like it doesn't even have gold in it. You know what I mean? Like it is remarkable in this frenzy of spending and irresponsible fiscal. It is amazing to me how few people are tapped in to the story that is the miners. And it really doesn't even matter whether you're talking silver or gold. Both are discounted to a point where you kind of look back at it and go, why is this so cheap? There must be something wrong with it that I'm not aware of. And there's not.
Yeah. And I remember we did the exercise early this year. I mean, we knew obviously the balance sheets were way better than the last 30 years or whatever, which is a huge, huge deal. But then we looked at the valuations on a forward PE basis, and you went name after name after name after name. And early this year, they were essentially all at or very close to, a 30-year low on the valuation standpoint. And it's like, here they are with this massive inflection, a cleaned up balance sheet, and they're insanely cheap. And obviously they've re-rated it, they've doubled, but to your point though, gold's almost doubled. So like, it's not like you got expensive along the way. It is remarkable. And obviously it's caught on a little lately, but not enough to make it expensive.
And there's a lot of different dynamics in play here than have been in any type of commodity cycle that I've seen before. Meaning, one of the things that you've always got to be conscious of in any commodity cycle is you can be right regarding your underlying projections and thoughts regarding the price movement. But the problem is usually when the price gets to where you're targeting, there's a wall of supply that meets it, right? Like, I think of oil, let's say you got $110 price target on oil. Okay. Well, enjoy it while it lasts, because it usually doesn't, because at 110, everybody opens up the spigot, right? Then you look over at the precious mining or the precious metals industry and you realize that there have been no net new mine openings for both gold and silver for like 15 years, right? So you're not going to have this giant supply hit the market. And then when you realize how long it takes to actually develop and open up a new mine, or even to unmothball an old one, it's far more expensive and time consuming than people think. And it's time consuming if you don't have red tape and government restrictions that make it a giant pain, but they've got all the above. So anyway, I think the setup there is incredible. And I think that, again, I see way too many investors way over allocated to what has worked. And really not, if nothing else, just not taking the advantage of so many other attractive asset classes out there, just at least for the purposes of diversification. I just think that there's historically bad risk management going on right now. And I think it's costing to both sides. I was explaining that to a client earlier today. Usually I've had a couple astute clients be a little bit concerned at the fact that we're up over 30% this year at the market. And they're like, Zach, but doesn't that mean that you're taking excess risk? And I go, I understand what you're saying. And there are a lot of people that if they looked at our portfolio, they would suggest that is what we're doing. But on a fundamental and evaluation basis, I think it's the exact opposite. I think that we have actually gotten superior returns because we've been taking substantially less risk. And that's not the only reason, but I think that's one of the reasons those things have gone up so much, is I think that there is a contingent of investors for the first time in quite some time, or a corner of this market, that are starting to get more value aware and are starting to wake up to, and maybe it's the international contingent. One of the things you and I were talking about is that these tariffs were going to cause dollar outflows, and the dollar outflows were going to, at least, at the very least, cause investors to look around and say, you know what, let's quit just making this a one decision type move of, oh, we've got cash, let's just throw it at the Qs and the S&P 500. At the very least, I thought it was going to make investors look around and go, you know what, let's take a peek at things. When I look at the way this market's behaving, it's really hard for me to come to a conclusion that hasn't taken place. It just feels like that in so many different ways, that all of a sudden investors are beginning to look in corners of the market, beginning to look on evaluation at fundamentals in a way that they really haven't for much of this entire run.
Yeah, and I think a company made the joke that the new 60-40 is 60% AI, 40% crypto. And so, so, and obviously he's right, but like if, or I should say, in a lot of ways, when the luster comes off of those, and at least, maybe just for a year or whatever, but and people have to stop looking at just those two big areas and look for, I hate to use the word, but value, like things that make a little more sense in real life. That's like good. Like what you're talking about gets like, it's on steroids. So it is crazy and I do think that is a very astute question to ask. Like anytime if I'm investing in something that's up a lot, I'm like, hey, whoa, like what, it actually would unnerve me. So I think that is astute, but you're right. Like it's some international stuff that's like 10 to 15 PE and precious metals miners that are like we just talked about, were as cheap as they had ever been, more or less. So like that's where all the returns came from. It's just that we got those outsized returns in two very cheap things together in 1 year. This made it look like we were taking more risk, and in reality, it's just two things happen to work at the same time.
Yeah, and again, when you talk about the cheap and the valuation stuff, so like another thing I was laughing about, I was like, usually whenever I've had a really good year like this, you kind of look at one thing and you're like, yeah, we took some, we pressed the bet on that and it paid off. And I was like, this has been the exact opposite. It's actually felt extraordinarily boring. Like how'd you guys do that? And well, we bought a bunch of stuff that just looked uneconomically cheap, and it was. You know what I mean? Like that's really all there was to it. And the irony, like we've been saying all along, is I see just as much of that stuff available out there as I did when we started making those picks. And I think right now, I very much believe that this will be a period of time where people look back and they go, we were taking way more risk than was prudent, but also way more risk than we needed to. There's plenty of opportunities out there that I think offer explosive upside returns, both in the near and further out time frame. And to me, it makes a lot of that stuff, that kind of stuff is always never, it's never attractive to me. I'm too much of a risk manager at heart, but especially with the stuff that we're seeing, the stuff that we're investing, I'll be honest with you, it just makes a lot of that speculative stuff just really unattractive.
Yeah, there's been years where it felt like, okay, this is you're in that or you're losing, and this year, like that's still there, but like not the or you're losing. It's like, oh yeah, but or you could be in the stuff that you like, that makes sense, that you can pencil out, which is nice. It's been a nice change of pace.
Yeah, it has been.
Yeah. Do you own this thing at 40 times earnings? Yes or no? No. Oh well, you had a bad year. Sorry. Like leaving that behind. I hope we never have to go back to that.
Yeah, boy, you and me both. Anything you got to add, man? I'm kind of shot for the day. I kind of feel like today played out exactly like we would have thought. And I think the story of this week's going to be probably told on Wednesday, Thursday, and Friday.
Yeah, I think tomorrow's important, how that goes. So keeping an eye on, that price action. Dollar kind of up and down, up today, seeing if that can follow through. And then keep an eye on on the volatility in all the metals. Like all the metals have just gone high vol all of a sudden. And then the bond market reopens tomorrow after the off day today. To see how that reacts after everything that just happened will be interesting. And more importantly, bond volatility has been put to sleep. And all of a sudden, it looks like it might be waking up. So to watch that the rest of the week is going to be interesting.
Interesting deal. It'll also be interesting to see if you start seeing some correlations. Like I wouldn't be surprised to see a positive and negative gold correlation pop up with bonds, meaning bonds down, gold up.
Yep.
It hasn't, at least to my knowledge, that trend has not made itself apparent or has not become dominant. But it's just one that has kind of fascinated me. I'm going to be curious to watch that and see if we start seeing that. But anyway, that does it for me. We will be back as always tomorrow, you guys. Thank you so much for tuning in, and not tuning in, but listening. As always, you can find us on social media, on Twitter, on the Instaface, as Chase likes to say. Google us, Know Your Risk Podcast. Also search Know Your Risk Podcast on YouTube. Not hard to find. Go to knowyourriskpodcast.com. Sign up, subscribe, download. You guys know the drill. We will see you tomorrow. That does it for us. Have a great evening. We'll be back tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe to Know Your Risk Podcast.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.